Oh, I even I haven't even started recording the session. All right, so I'm glad to see 12 people today. Actually, let's see how many people are in the forum. I believe there's more than 12. Yeah, it looks like at least there are 14 people. Uh,
Yeah, I need to do that real quick. I need to sign in real quick. I forgot.
yeah, please do that. That's the first thing to do. That's always the first order of business. All righty. So, let me pull up. Uh, the slide is not where we left it off. Yeah, I think we were. Um, so I was talking about um, how the no, not this one. I don't think it's this one. I believe this is yours. Okay. Yeah. So, yeah, here. I was speaking 90%. Um, so I was talking about why the formula eventually takes up certain, form. For example, we all know there are four.
Professor, sorry, good morning. I cannot see your if your screen your screen is black.
Uh, how about everybody else? I'm sharing my screen. Can you all see my screen?
Yes.
Yeah,
Yeah.
Professor.
Yes,
Oh,
Professor.
yeah. Good.
Yeah,
So I
sorry,
think
maybe it's my connection. Sorry.
yeah, it's your computer setting. You might need to probably either close the browser, reopen it, or you know also check your memory. I mean, see, your RAM status. If you usually your RAM is I have 8 GB of RAM, and I barely have 1 GB left. So that means my computer is using
Yeah,
so
now I
much.
see it.
Okay, good. So sometimes refreshing the browser would help. So if too many windows are open, too many things are open, that's taking up a lot of space. I mean, memory. Um, so um, okay, we all know that the stock valuation model is dividend discount model. Okay, dividend discount model is a kind of discounted cash flow model, right? Discounted cash flow model. And if you understand the concept of sets, right? You will know what that means. That's a subset, a part of uh, a bigger set, right? So dividend discount model is a subset of discounted cash flow model. Now, so stock valuation models, bond valuation, there's only one, right? Bond valuation model is only discounting all the future coupon payments and maturity value. But in stock, uh, similar concept, but then they all boil down to one of the four models, right? The first model is zero growth model or constant dividend model, right? Or perpetuity model. They call it by different other names. But the point is, value at time zero, right? Value stock value, so intrinsic value. We're not calling it price because we are not talking about the market price. We're talking about the intrinsic value. Value at time zero is dividend over R, right? Of course, R being the discount rate. Discount rate in this case is the required return, right? So the question is then still, we still have the question. Then how do we find what's the required return? How do we find the required return? That will be another story. That will be another topic. It will be, CAPM. When we get to CAPM, then, but assuming that required return is given, but how then? How is the model? How does obviously think about it. It's going to be dividend at time one, divided by 1 plus R, plus dividend at time 2, plus 1 plus R squared, and dividend at time 3, divided by 1 plus R cubed, plus the ellipsis, right? That, and then all the way to dividend at time infinite, right? The discounted by 1 plus R raised to infinity. But how does that reduce to this form, right? That was our question. And this one is called, I don't want to repeat this over and over. Constant dividend. Constant dividend model. Dividend. Or zero growth. Perpetuity model. Okay, so we need to we just stopped right before explaining how the long polynomial reduces to this, and then the second model is what they call constant growth model or golden growth model. It's so difficult. Which is dividend at time one, next period dividend, or time, sometimes T subscript, time subscript is T plus 1 over R minus G. Okay, which is called, constant growth model or golden growth model. So we're gonna look also into why and how did it turn into that long polynomial turns into this final form, right? And the third one is multi-stage model or variable growth model. Variable growth model or multi-stage model. Multi-stage. And the fourth model is free cash flow model. Free cash flow. Okay. Now, actually, third model, number 3 and number 4 are an application of number 2. Okay, application of number 2. So I won't put down any structural model for that. And then now let's think about it. So we all know what I was trying to do last time was, so we all know value at time 0 in constant dividend model. Dividend is constant. Dividend is constant. So it's we don't need time subscript because there is no difference between dividend at time 1, time 2, time 3, time 4, time 5, right? So we'll just call it dividend because it's a constant, right? And then we have to discount it by 1 plus R. And then the second period dividend will be discounted by 1 plus R squared, right? And so on. It's going to keep going on like that until dividend at one plus R at infinite time minus 1 and infinite time. In other words, before, because it's going to infinity, right? We discussed this last time. Stocks go on forever as long as the company doesn't shut down, right? The stock will go on forever. So it can go on. It keeps going into infinity, right? And then infinity minus 1. I mean, if you can just pinpoint that infinity, right? And also, infinity, we cannot actually, if you can, as I said, if you can pinpoint that infinite time, right? Also, at that infinite time, if we can identify, the price of the stock at the time. But of course, it really does. It really doesn't matter whether we can pinpoint the stock price at the time or not, because all we just need to assume that there will be a price of the stock at infinity. There will be a price. In other words, the price will be a finite number, right? And I explained last time why it is going to be a finite number, right? If you don't remember, please go back and review the live session recording, right? So even though that's the stock price at infinite time, it's not going to be an infinity. It's not going to be an infinitely large number. It will be a finite number. Whereas this is going to be an infinitely large number, right? Anything, think about it. Even 2%. 2% is one, then 2%. If R is 2%, that's going to be 1.02. But 1.02 raised to infinity. You raise 1.02 to infinite power. It's going to be an infinity. Any number, anything that is greater than 1, even slightly greater than 1, will be infinitely great number when compounded infinitely, right? Then think about it. This is a finite number. This is an infinitely large number. So basically, what's gonna happen? What's gonna happen? It will become, right? You divide of come on. It will become close to zero, not zero, not perfectly zero, but close to zero. Okay. For the same reason, this will become the same thing, right? It will become the same thing. But for now, we'll leave it. We'll just leave it like that. And then we call this. Let's call this equation 1. We'll call this equation 1. And then I'm going to multiply equation 1 by 1 plus R. Okay, and then call this, if I multiply equation 1 by 1 plus R, that I will call it equation 2. Okay, that's going to be equation 2. Then think about it. What's going to be that like? What's going to be equation 2 like? Equation 2 will be so equation. Where is it? So equation 2 will be because you're multiplying everything by 1 plus R, the left-hand side and both left-hand side and right-hand side must be multiplied by 1 plus R. So the left-hand side will be V0 times 1 plus R. The right-hand side, first term will be dividend. Because if you multiply 1 plus R, then 1 plus R, they will cancel out, right? The second term will be dividend over 1 plus R only, right? Because 1 plus R multiplied here, the numerator multiplied to the numerator will cancel out. In this case, it will exactly, in the first term, it will exactly cancel out the denominator. The second term, the denominator will 1 plus R, 1 times 1 plus R in the denominator. One of that 1 plus R will cancel out with the numerator. And then everything following, right, after that will lose 1 from its denominator, from the exponent of the denominator, right? And this one will become 1 plus r raised to infinity minus 2. And the last term will become dividend over 1 plus r infinity minus 1. And then think about it. We're gonna, then next, we're gonna, so this is, equation 2. And then next, we are going to subtract. We're gonna do 2 minus 1. We're gonna subtract equation 1 from equation 2. Now, this is the fun part, really. This is the fun part. So think about it. If we subtract equation 1 from equation 2, everything in equation 1 will have a minus sign. Isn't that right? You're subtracting. So everything in equation 1 will all have minus sign. The whole thing, also the whole thing, right, will have minus sign, right? I think I better. Okay, the whole thing will have minus sign because it's, you're subtracting 1 from 2, right? So then think about it. 80%, 80 or 81 done. So in the left-hand side, what's going to happen? In the left-hand side, it's going to be 1 plus r minus 1 v0, because you're subtracting v0 from v0 times 1 plus r, right? If you factor out v0, right, it's going to be like this. And then you'll have dividend. And then everything this and this will cancel out. This and the next one will cancel out. Everything, and then this term will cancel out with that. And then again, these two terms will cancel out. And then you're left with, finally, then you'll be left with, and of course, 1 and 1 will cancel out. So on the right-hand side, you'll be left with only dividend plus, minus then, oops, y minus. Because the only thing left on the right-hand side, no. The only thing left on the right-hand side is this term, and this one is minus, right? It's negative because the whole thing, entire equation 1 was subtracted. But this is pointless because whatever is left there, dividend over 1 plus r raised to infinity. But we know this thing is close to 0, right? So it's pointless. So we are finally then left with r times v0 equals dividend. Okay, then what is our unknown? I mean, what are we solving this for? Our unknown is this. This is what we want to know. Isn't that right? We want to know the intrinsic value of this stock at time 0. So then solving for that, solving for 0, v0, dividend over r, right? Hence the reduced form for the constant dividend model. All right, everyone is okay with this? Everyone has followed? How come no response? Anybody? All righty, Shabir. Okay, Shabir. Only one person responded.
I will be reviewing it again, but yeah, I got most of it, Professor.
Okay, I mean, I've been, going very slowly. So this explains why why it takes this shape, right? Why the first model, right? Constant growth model. I mean, constant dividend model takes this shape, right? Or zero growth model. And then next, why does it look like this? The golden growth model or constant growth model, why does it look like this? And where did that G come from? Out of blue. And where? So to explain that, I will need to no, not where did I put it? I know where I put it. Okay. Out of memory, so this is the problem. What should I do? Maybe I should close this, whatever is. Okay. So let's see. I'll have to close something to dump the memory, and I don't know what I can close. Close this, close this. Even then, doesn't. Okay. Close this, close this. Let me try opening that again. Why does it do this continuously? All right. It's kind of visible from the from here. Why isn't it visible from there? Let's try this. Okay, whatever I can do. Let's try this. So oh no, not this one. No wonder. Where is risk and return? Okay, let me try to open this. Okay. Okay, all right. So I hope you can see this well, because I'm not opening in a PDF reader, but just kind of previewing from from the folder, right? From the folders preview. So can you see this? Now, think about it. What stock does to you is, okay, let me also write it here. In case of golden growth model, and we'll have to assume, right, an equilibrium condition, right? In equilibrium, right? Market price is the same thing as intrinsic value, right? So in equilibrium, under equilibrium condition, right? The market has a perfect foresight. In other words, that means market participants have a perfect foresight. So they know exactly what is what kind of cash flow is expected in the future. So they can, and they know perfectly what is the correct required return. So uh, everyone in the market can nail the exact intrinsic value. And then there's no reason for market price to deviate from the rational price or intrinsic value or the fair value, right? And if that's the case, look, we know stock price at time zero is the okay. Stock price at time 1 is the result of stock price at time 0 times 1 plus R, right? That's exactly the compounding, right? Price at time 0, right, compounded by the required return will be exactly the price at time 1. And then price at, it's not just the price at time 1, but think about it. The stocks, so I'm going to have to rewrite this. It's not just price at time 1. It's going to give you also the dividend at time 1, right? It's not only the price at time 1, it's going to give you a dividend at time 1. In other words, this is the reason why you buy stock, because the price at time 1 will be greater than price at time 0, and you will also have dividend. And also, if you took Finance 100 with me, you would remember the house value example. House value, right? You bought the house, and if you buy the house, there can be two uses, right? Two possible uses of the house. One, you use it as your home, so then it's just your residence. In the second case, you use it also as a rental property, right? So the first case is, I call the first case scenario 1, second case scenario 2. In scenario 1, the house value will just change over time. House value will change. It can go up or go down. And 10 years later, hopefully your house value will be much greater 10 years later than 10 years ago, right? And that's just capital gains. Of course, there can be capital loss. 10 years later, it could be even lower than when you bought it. But during this 10-year period, of course, there will be a lot of fluctuations, but it's a house value. It won't be like the fluctuation of the stock market, right? And then so in scenario 1, you don't have this in scenario 1. Suppose the P0 is the house value at time 0. P1 is the house value at time 1. Of course, R is the growth rate of the house value then. But that's the scenario 1. But in scenario 2, you are renting out, so there's rental income, right? So this means if you rent out the house, you pay, P0 is the house price of the house that you bought. You paid that price, and then a year later you will have price at time 1 and rental income at time one. Of course, this D1 rental income at time one is actually the total of the rent you received during year one, right? Remember, 0 is the beginning of the timeline, so 0 is the beginning of year one, okay? And 1 is the end of year one, right? Makes sense? So the stock is like stock and bonds are like stocks and bonds are like the house value in scenario 2, right? There is additional income. Of course, you remember the bonds, the 0 coupon bond is just like scenario 1 in house value, right? Scenario 1. Because, if it doesn't pay any interest, it's going to be there's going to be only capital gains or capital loss. And dividend, also, if the stock doesn't pay any dividend, it's going to be like scenario 1, right? Now, let's think about it. Then, in scenario 1, return was exactly just the growth rate in scenario 1. In other words, if you just don't rent out the house, but just live in that house, there's no additional income. There's no additional income. So it's just like, the growth rate is the only return you get from, that scenario. Excuse me. But in scenario 2, you'll understand. I hate to spell out everything. The scenario 2, they are not the same thing, right? Growth rate and return are not the same thing. Return is greater than the growth rate. Growth rate is just the part of the return, because growth rate is only the change in the stock price or the house value. So I just hope this works. Now, why is it still doing this? I killed off a lot of things, and I have more memory now. What if let me completely, okay, reopen it. Close and reopen. Oh, okay. And it's gonna work now. So I think it looks better now. So here, K, you understand that's cost of capital, right? So that's required return, because in stocks, required return is the cost of equity. So then let's divide both sides by PT, right? Just to isolate, K. To isolate K, you have to divide both sides by PT. And if you do that, yeah, and then we can rewrite PT plus 1 like this. What is PT plus 1? PT plus 1 is PT times 1 plus a growth rate. Isn't that right? Isn't that the definition of, right? If we divide both sides by, to isolate R, right? It's going to be P1 plus D1 over P0. And then on the right-hand side, 1 plus R. And then we can rewrite P1 as P0 times 1 plus G. Remember, if you're looking at the house value only, right, the increase or decrease in house value is because of the growth rate. I mean, the growth rate in the house value can be calculated by, in other words, growth rate is what? P1 minus P0 P0 over P0. That's the growth rate, right? And then R is different because R is what? R is P1 minus P0 plus dividend over P0. That's R. That's the return. And P1 minus P0 over P0, that's just the growth rate, right? In other words, this is called capital gains, right? So growth rate is only when there is only capital gains, no additional income. This is additional. Dividend is additional cash flow, right? So this looks, I don't like this. So you see P1 can be rewritten by its own definition, and then plus D1 over P0, that's 1 plus R. And then think about it. If we rewrite, we can rewrite algebra is nothing but just, redefining, defining by, is quite deductive reasoning because you are defining it by its components, You're defining something by its own components, right? So then we can rewrite this as P0 plus P0 times G plus D1 over P0. That's, 1 plus R, right? And think about it. We can all break this up because it's going to be, we can all break this up, right? P is P0 over P0 plus P0G over P0 plus D1 over P0. That's what 1 plus R is. The 1 plus R is the gross growth rate, right? That's the growth rate. And then what is this? This is 1, right? This is G, right? PG, cancels out. So what does this become? This is exactly 1 plus G plus D1 over P0, 1 plus R. Now, don't do this. It's just moving, I don't want it to move, but it's moving at its own will. So then think about it. We're gonna have to move this to the other side because D1 and P0, that's all variable zones, and 1 plus G, at least you need to collect the like terms, right? Constants with constants, unknowns with unknowns. But if you so transpose it to the other side, right? Left-hand side will be D1 over P0, and the right-hand side will be 1 plus R, and the whole thing will be minus, right? That's going to be minus 1 minus G. They cancel out. We come to R minus G, right? Then think about it. There you go. We're almost there. What we want to solve this for, right? Right? What is the unknown? I mean, what do we want to know? What do we want to know? P is our, this is our unknown. This is the unknown. Isn't it right? P0 is our price is our unknown. So if we solve this for P, right? You divided D1 by P0 and you got R minus G, then P0 will be solving for P0. That's going to be dividend at time 1 minus over R minus G. Isn't that right? In other words, right? If Z divided by Y is X, X is Z divided by, Y is Z divided by X, right? Now we are there. What is this? Isn't this exactly the Gordon growth model? And under equilibrium condition, we assumed equilibrium condition, and under equilibrium, V0 is P, right? Dividend at time t plus 1, right? Or dividend. I'll just call it then dividend at time 1. R minus G. Okay. Again, P and V are not the same thing most of the times, but only under equilibrium condition, right? We assumed equilibrium condition, right? In equilibrium, P is Z, P is V, right? Market price is the intrinsic value. So basically, this is why these dividend discount models are all called equilibrium models, because under equilibrium, market price is equal to the intrinsic value, right? And correctly priced, that means in equilibrium, the stock is correctly priced, right? In equilibrium, all the assets are correctly priced, or just priced, or justly priced. no underpricing or no overpricing, right? I think this is time is right. It's about time to take a break. So if you have any questions, I'll take the questions, when we come back. Okay, let's take a 10-minute break, right?
Professor, I sent it to you a message on the chat. Professor, I sent you a message on the chat.
Yeah.
I had a
Let's see.
question. Is like, I missed out the homework stuff a few weeks ago because I thought it was like no due date because I didn't
Okay,
do it.
so this
Can
is
I
you,
reopen?
this is
Yeah.
you, Cillian.
Yes.
Okay. Yeah, no, there's no problem. Look, they have deadlines, right?
Yeah.
But
I
you can,
noticed the deadline.
yeah, but it's not absolute dead. I mean, there's a deadline, but you can do it late. You can submit it late.
But
Okay.
the previous ones are no longer there. I just want to do it for malpractice. I understand I don't get grades for it, but I want to do the previous ones.
You can do the previous one. As I said,
It's not there anymore.
well, it is there.
When I uh, right now, I don't
this is
see
the
it.
student view, right? This is how it looks to the students. It is there. It's visible. It just says it's
No, the
late.
one before that. The one before those.
There's nothing before this. We started
I
with
remember seeing
we started
one
from
that's
chapter
like 4.
no. We started with chapter 10. Chapter 10 is the bond valuation. This is the one. We started with chapter 10, right? It
Yeah,
was
but I
due
remember when I
February.
went inside, I saw like there's 4 parts, 4 of them that it was due last time. Like last week, I saw it was already due, so I thought it was going to. I didn't see expiration, so I didn't do it. Like 4, it says 4 different parts.
I don't. Okay, I don't know what you're exactly talking about. It maybe, are you sure it was this class? Because you have only, what is past due is only chapter 10, okay?
Mm-hmm.
Chapter 13 is due today, right? And whatever has this arrow sign, arrowhead, that
Yeah.
means that's open. But you have only 2 open now. Chapter 11 is not even open.
Okay, let me see if I did this one.
Okay, this is, I mean,
Okay.
as far as I can see, this is how it is seen from your end.
Okay, I see it.
Okay,
Okay,
all righty.
thank you.
You're welcome. All righty, back to our okay. So now you see where that came from. Now it's going to be we're going to do a little, these uh, the examples of these models are not that difficult. We're going to get to that after discussing a little more about the implication of the Gordon growth model. So now you see the expected return, here, specifically expected holding period return for stock in equilibrium, right? So it's only when, only when uh, only when it is in equilibrium, the market price is equal to the intrinsic value, right? And then, so the expected return, right? Again, this notation, right? This symbol, the expectation is called expectations operator, right? And you might wonder, I mean, isn't it just, you might wonder, isn't it just, isn't it just word? Isn't it just a word? I mean, whether it is like this or like this, aren't they the same thing? No, they are not the same thing. What this this is actual, right? Actual return. Actual, in other words, it's realized return, or sometimes it's also used for required return, right? Actual required return, right? When we have expectations operator, that means it's just an estimation. It's an estimate. But then estimate, you might think, oh, what's estimate is something, an approximated value. Estimate is some, a projected value. Well, in economics and finance, or in math, estimate and forecast mean the same thing, and expected value also mean the same thing. So forecast, projected value, estimate, they all mean the same thing. But then they are not just random, some wild guess. It cannot be. It cannot be a wild guess. It's actually a expected return you may have seen from Finance 100 is usually the average return of the past returns. Okay, average of the past returns, past past 5-year returns, monthly returns, or because if it is past 5-year annual returns, that would be very neutral number. I mean, first of all, annual returns, you have only 5 data point. You have only 5 data point, right? Past 5 years, you will have only 5 data point. What kind of, any, reliable forecast can be generated from that? So it's, if you have to make, statistically meaningful, to make a statistically meaningful forecast or estimate, you need to have at least more than 30 data point. At least more than 30 data point. And the reason is to ensure normal distribution properties, normal distribution characteristics. You need at least, more than 30 data points. So over the 5 years, if you have, like, if you use monthly returns, right? Then, average of the monthly returns, I mean, over 5 years, you will have at least, 60 data points. That will ensure, that will be more than enough to ensure normal distribution characteristics. And the normal distribution characteristics is important because the data should not be biased, right? In other words, data should be like random. Like, actually the reality, to represent the reality, the data should be randomly selected data, random, right? And the, mark returns move, returns have, that random characteristics, right? You might wonder, doesn't the market have certain, trend, market has been going down all these, almost, a month. Sometimes it's, on a rally. So there's an upward trend, sometimes downward trend, sometimes no trend. Yes, if you're looking at the price, right? Of course, if the price has downward trend, return will have downward trend too. The point, what I'm saying is, price may seem like, fluctuating like crazy. But the fluctuation return is relatively relatively within, I wouldn't say stable, but less fluctuation in returns data would be less crazy. In other words, it's more smoothed out than the fluctuation in price. Of course, think about it. Return is the result of price movement. So obviously, once filtered, once screened out, once it's processed, right? So obviously, we'll show more smoother pattern than the price movement. Anyway, the point is, when we say expected return, it's not just wild guess, but it is let's say it is the average of the past returns, right? Simple average of the past returns. And some people might wonder, don't we use geometric average? Yes, we use geometric average, but when there is obvious compounding effect, when there is an obvious compounding effect going on, like annual house value data or annual, if you look at the annual prices or price data of the stock, you see clearly, you will see compounding effect. Look at like Apple, right? Over 40 years, it's been growing. If you look at the annual data, it's been growing only. It's been growing, right? If you look at the annual data and overall, over 40 years, it's been growing only, right? Of course, sometimes 1 year in a particular year, it may have lagged, but through and through, the average trend is growth, right? And that also happens. That's also same thing, monthly. If you look at the monthly data, some months, it may have been, it may have dropped, but overall, if you average it out, it's growing. The growth pattern is, clear. But when we so annual, if you look at the annual data, right, and taking the average of the annual returns or growth rates, yeah, geometric average. But month to month, week to week, especially the shorter the shorter the time frame, right? The shorter the time frame. The shorter the time frame of the data. In other words, monthly data, weekly data, daily data, daily price, especially daily price, daily returns every day. What kind of do you see any? Do you see any growth effect between the day one and day two? Between the returns of each day, you don't see any particular compounding effect, right? These daily returns are really like random occurrence, just like drawing a ball from a sack of let's say this is a very basic example in probability theory. There's a ball, there's a sack of balls. There's a sack of red balls and white balls. in a sack. And in the probability exercise, question is, there are 60 balls there, and only one red ball. 60 balls, only one red ball. So that means 59 balls are white, only one red ball. What's the probability of, you just put your hand in the sack. You're blindfolded. Sack, nobody knows what's in because you're blindfolded. You pick out just one ball. What are the chances of that ball being red? Of course, everyone knows it's going to be, the probability is 1/60. If there are three red balls, 60 balls in the sack, what's the probability of red ball coming up? Oh, that's 3/60, of course, which is 1/20, right? Also, dice game. You're throwing a dice. What's the probability of 6 coming up? 1/6. All the numbers, 1 through 6, they all have the same probability of 1/6. Flipping a coin, what's the probability of the heads coming up? What's the probability of tail coming up? 50%. Because it's only two-sided, right? Two probabilities. Now, then think about it. Daily returns are just like daily returns are. It can be any number, right? It's like picking out a number from a sack of numbers. So daily returns are not correlated. I mean, you don't see any correlation between, like compounding effect between a day's return and the next day's. Okay, one day it went down, another day it goes up, another day it goes down again. But this can happen repeatedly in a series. Like, but it's not because of any of the fundamentals. There's no, these days the market has been going down. Oil price has soared. Why? Because of the war in Ukraine. And Putin should be definitely held accountable for, this this unnecessary disturbance in the global economy, because the oil price wouldn't be like, the oil price is almost like $4, a gallon. Gas price, almost $4 a gallon. And the stock market, think about it. U.S. economy is very, very strong, and very. If anybody says U.S. economy is bad, it's because that person is ignorant. Why? Unemployment is the lowest historical low. Anyone who wants, willing, and able-bodied to work will find a job. And the wages are rising because there is more demand for there is more demand for labor, workers. In other words, there are more job openings than job applicants. And people who are, who want more, income this is the time to, apply, do the job hunting, because they will always end up with a better. I mean, I read an article that even the headhunters are headhunting. I mean, headhunters are headhunting. Headhunters are headhunting. Right? Headhunters are headhunted. In other words, there's so much, even, openings for headhunters even. inflation is inevitable in a growing economy. I mean, if you don't know this yet, I mean, the very basic macroeconomic, of course, we are not only, inflation is, caused by strong demand. Of course, our current inflation is the result of both, strong demand and, short supply, right? And rising cost, but rising input cost. But short supply means short supply of raw materials. It's because because of strong demand, and supply of raw materials cannot meet that strong demand. For example, semiconductors, microchips, they need to produce 10 million automobiles this year, and all these automobiles must have microchips in them. Microchips are in short supply because of supply chain disruption. I mean, if the automobile production schedule is not 10 million cars, but let's say 5 million cars, we won't even have this supply disruption. I mean, a shortage in supply. But the bottleneck of this supply, due to shutdown, of some shutdown of some cities, some industrial centers, because of the shutdown due to COVID. Everything is, seeing a bottleneck. Even the freight vessels, right? So first of all, even through all that, supply chain disruption, economy has been strong. That's why demand is so strong. Of course, the reason the demand is strong is because every sovereign government have taken some, expansionary fiscal policy posture. U.S. Stimulus checks, consumption never went down. People didn't hunker down, even during this pandemic. So the economy was, of course, you might wonder, I mean, isn't it a bad thing if they during the recession, if you hunker down, it's really the bad thing, because if you hunker down, then that only feeds back negatively, adversely back into the economy. If you cut down on spending, somebody will lose job, right? In other words, if you tighten your belt, it only makes, think about it. It's the ignorant Republican politicians that say, the economy is in recession, and then governments must cut down on spending. Everybody, it's when the hard time hits, it's only right to tighten your belt. So should the government. Look, it makes sense to individuals to tighten their belts when the hard time hits, but if the government tightens their belt, then some people lose, the economy. In the economy, one person's spending is another person's income. That's basics of the economics. That's the basics of the macroeconomics. One person's spending is another person's income. So if you tighten your belt, someone will lose their job. Of course, you'll have to tighten your belt when when the hard time hits. You may lose your job, any day. But that's where the government spending comes in. Why are the governments paying out stimulus checks? So that some people won't lose their jobs when you are tightening your belt, right? But then these, ignorant, always, I don't know why, but because Republicans are, the red states, what they call red states, the Republican dominated states. They all support Trump, still support Trump. That's very ignorant. And basically, Republicans, platform is, their tenet is small government, small government. And what does small government means? What their government is not picking up this slack when the recession hits. Everybody's tightening their belt. Government is not picking up that slack. Government is also slashing. During the good economy, government may be small because the private sector is doing well. So private sector, everyone is employed, everyone has a job, everyone's income is going up. So the government doesn't need to spend. But during the bad economy, a lot of people lost jobs. Companies are downsizing. Then when people lose jobs, they don't spend, there's no money to spend, then companies will have to further downsize because their products are not sold. They will have to lay off more people. This is a vicious cycle. The only way to, prevent that vicious cycle is for the government to spend, government to provide jobs, public sector jobs, so that the economy won't go into this downward spiral. But all the Republicans want is, small government, through thick and thin. In other words, during the good times or bad times, regardless. Why? Because government spending takes money, and that money comes from the taxes. Now, of course, everybody would want to pay smaller taxes, but especially the top 1%, wealthy 0.1%, top 1%, corporations and wealthy don't want to pay taxes. I mean, they generally pay zero. The wealthy corporations, a lot of wealthy corporations, through the tax loopholes, avoided paying any taxes. They practically paid 0% year after year. And the wealthy top 1% and wealthy corporations lobby, they bribe, they pay these, Republican politicians. And the Republican politicians are mouthpiece for these, top 1%. They fight to keep their money coming in. So they resist, taxing on the wealthy. When they talk about raising taxes, it's not on people like you and me or someone who makes less than $100,000 a year. They're talking about raising taxes on those who make more than $50 million, at least $500,000 a year. Who amongst us come even close to $200,000 a year? I mean, even if you make $200,000 a year, you're probably top, you would be in top 2%. But top 1% and 0.1% make more than $500,000 a year, or even more than $5 million a year. and raising taxes 1%, just by 1% on these, they resist with all their might. And stupid enough, all that, red states are Republican states. And in these states like Kentucky, North Carolina, Texas, the majority of them don't even make $100,000 a year. Majority of them make, even, probably, not even $50,000 a year. And then they support Trump. They support Republicans. They think, when anything, Democrats, propose, tax raise, as if they are coming to take their tax. They are not touching you. You don't even make $50,000 a year. They are not touching your income. Idiots, huh? They are really morons, those Republican, Trump supporters. They are not even making $50,000 a year, and they think they are being taxed. I mean, the tax raise proposal is about them. They don't seem to be, touching, I mean, they don't seem to be, having any rationality or even, touching the ground. They think they are 1%, that top 1%. Or do they really believe they are top 1%? They are part of the 99%, and they think Republicans are working for them. Republicans never work for them. Only in the 19th century, it was the opposite. Democrats were, it was the opposite in those days. But even, until the first half of the 20th century. But from the second half of the 20th century, especially from the 1980s, post-1980s, Republicans are only working for the top 1%. Most of all, Trump is top 1%. And who do you think is, do you think he's, passing the law? I mean, if, of course, the laws are passed by the Congress, but eventually he will have to sign. He has the power to veto. Do you think he will veto the legislation that is in favor of top 1%? No, he won't. Because, it will be, to his own detriment. Why would he do that? He won't veto anything that would be against top 1%. He will veto whatever is promoting the benefit for the 99% and, costing, just a little more, even just a little more to top 1%. He will be, he will veto any legislation like that. So, okay, I'm sorry. I digressed. I got carried away too much. I digressed a lot. So, as I said, expected return. Sometimes, I use K for this. K, because K is more broad. It's more comprehensive concept. It's the cost of capital. So you all know cost of capital can be, cost of debt and cost of equity, right? Cost of debt is the, yield, bond yield. Cost of equity is then required return, right? Required return. So it can be used. So think about it. Although if the expected return is equal to the required return, that's only under equilibrium. The reality is it may be more like this or more like this, right? The reality is the expected return and required return are not the same. And then so that brings us back to this. We understand expected holding period return. Don't get carried away by the differences in the notation. Holding period can be 1 year or 1 month or anything, 1 quarter. So ignore. We'll just assume holding period as 1 quarter, right? 1 quarter. Why 1 quarter? Because basically they pay dividend. If they pay dividend, it's quarterly, right? So the model, basically, dividend discount model. Think about it. All dividend discount model must be, basically assuming, we are dealing with quarterly data, because otherwise we don't have any dividend, right? To have, dividend as part of our model, then the data must be quarterly. Okay, so assuming, and of course, there are companies that don't pay any dividend, right? So I've been telling you, for such a case, that's why we have free cash flow model, right? So then think about it. Expected return is the result of we did this in the previous. You see, let me. So PT plus 1 plus, okay, let me just to make it easier to write. Dividend 1 plus price at time 1 plus dividend 1 is the result of P0 times 1 plus expected return. Okay, again, this is under equilibrium, right? Under equilibrium, okay, oh, it was green. This thing is the same as K or R, right? The required return. So if we solve this equation for it's going to be P0 plus P0 times E. And then move this to the other side. P1 minus P0 plus D1 equals P0 times expected return. And then isolate only expected return. I mean, this thing, at least this type of math, you shouldn't be, uncomfortable with that. This is very basic, right? And then is this? We can break it up like, of course, what is this called? This is capital gains, right? This is called capital gains. And this, the whole thing, I should have, this is called capital gains yield. Okay, this is called capital gains yield. And this is called dividend yield. This is called dividend yield, right? So that's what it is saying. Okay, dividend yield, capital gains yield, right? And capital gains yield is, in other words, that's what is called growth rate, right? Mathematically, think about it. This is what? This is growth rate, nothing but growth rate, right? Now, when we talk about yield, you might remember, isn't that the bond thing? Bond. Yes, you saw it from the bond, and there are two types of yield. Yield to maturity and current yield. Yield to maturity and current yield, right? And I told you, yield is another name for annualized return, right? And in bond, what was current yield? Current yield was, annual coupon payment, right? In bond. Annual coupon divided by price of the bond that you bought. Whatever, it doesn't matter, of course, it will be time zero, but the price that you paid, right? That's called, in bond, it is called, current yield. Right? So dividend, it's only, not difficult to understand, why this is called dividend yield. Dividend yield is like the current yield in bond. Okay. Also, you remember dividend comes from where? Where does the dividend come from? Dividend comes out of where? Anyone? Where does the dividend? Yeah. So profit. Yes. Of course, dividend is paid out of profit. And who said that?
Irina.
Irina. Okay, Irina. Yes, Irina, you're getting 0.5 for that. Should I write it down? Okay. So today is this is fnb300. Today is 0305. Irina. Yeah, you got 0.5 for that. Yeah, because dividend is coming from profit. Another name for profit is, anybody? Another name for profit is? It comes from profit, but what's another name from profit? Another name for profit?
Income.
No,
The revenue.
no. How can
Dividend.
profit be
Earnings.
revenue? Income is gross state. Revenue is still gross state. You arrive at profit. You arrive at
It's net
profit.
income.
Yeah, another name for profit is net income. Yeah, you're right. And who said that?
Irina,
Okay, Irina, you got another 0.5. So let's make it very clear. If you're still saying, if you cannot still, distinguish between, profit and income, if you cannot set them apart, it's serious. I mean, you are in trouble. And I've been making this very clear. In accounting, they use the term income and profit interchangeably, and that's what I don't like about accounting. But at least they don't call the gross income profit. They don't call gross income profit. I mean, we talked about it last time, right? This can we call this? Can we call this profit? No. I mean, operating, I've been telling you, you subtract from income, which is mainly revenue, you subtract expenses, and then you arrive at operating income. But again, I don't like to use income here. It should be called operating profit, right? And then you subtract, interest and taxes, and you arrive at net income. But again, rather than income here, it's better to call it profit. And then just because operating income is operating profit, net income is net profit, does that mean this is profit? No, you're making a very gross mistake then. This is something you have to instill in your mind. This is something you have to clarify in your mind and nail it down. Nail it down. Like, this is like, calling Russian army, Ukraine army. Think about it. Russians and Ukrainians are shooting at each other. You're calling, Russian army, Ukraine army. It's the same thing. If you're calling this profit, it's like just not knowing you can't tell what's just because it looks dark. Not everything is chocolate. Just because everything is looks brown, it's not chocolate. It's not like being able to it could be it could be bull crap. Sorry for the language. I mean, it could be feces, but they all look brown. And just because they all look brown, can you call this can you call one the other? Can you call Jesus. Dirt is also, it looks dark and brown, and also can you call dirt chocolate? So this is something you have to clarify in your mind. And this is Finance 300. And even at this point, you cannot tell the difference between income and profit. Then, you're doomed, you're doomed. Literally, you're, well, I'm sure, you guys will, you will have to sort it out. But by now, it must have been sorted out. It will take time, but by now, it should have been already sorted out very clearly in Finance 100. But if not, at least by now, it must have already been clearly sorted out by now. So here, again, so dividend comes from the net profit, and another name for net profit is EAT. Okay, and the per share EAT, net profit, EAT, these are all aggregate concept. Per share concept is per share, you divide it by number of shares. I wish I could, write this better. If you divide EAT by number of shares, what's that called? If you divide EAT by number of shares, it's called earnings after taxes. You divide it by number of shares, it should be called what?
Earnings per share,
Yeah,
Professor.
earnings per share, earnings per share. That's literally, it should, and who said that? Who said
Damien,
that?
Professor.
Damien. Okay, Damien, you'll get 0.5. Think about it. That means, dividend comes out of earnings per share. And because when we say dividend and price, that's all per share concept, right? Dividend at time one, per share concept. So dividend comes from earnings per share. If they don't pay out any dividend, right? Of course, then dividend is zero, but think about it. And you claim, basically I'm the shareholder, so that belongs to me. I mean, if I have 100 shares, earnings per share times 100, that's my share of the profit. Isn't that right? But again, we all know company doesn't distribute the profit to the shareholders. Company doesn't do that. If you want to recoup that profit, you just simply need to sell the shares, right? But suppose the company distributes all the profit. Basically, then, in other words, dividend is 100%, right? In that case, dividend is 100%. That means 100%. In other words, 100% of the earnings per share is paid out as dividend, and then it would look like this. I mean, dividend yield will look like this. But in this case, what is that called? Think about it. If dividend over price is called dividend yield, earnings per share over price, what should that be called? Because we're talking about, what should that be called? Anyone? What should it be called? This is called capital gains yield. This is called dividend yield. This is called current yield. And what should this be called? Well, this is called earnings yield and earnings yield. Earnings yield, right? Look at the common thread in these names, You divide it by price, that's divided by price, it's called yield, okay? Now, earnings yield is a very a clear, indicator. Earnings yield is a very clear indicator, a very obvious indicator of earnings power of your stock. If you think about it, if you bought a stock for $100, it's a $100 stock, and if it gives you earnings per share of $20, right? The earnings yield is 20%. That's a very direct measure of direct metric, right? That's a very direct metric of the earnings power of that stock. Isn't that right? That's like 20% return. I mean, rather than just looking at the dividend, right? I mean, think about it. There is another stock. It's $100, but the earnings per share was $5. I mean, between the two stocks, which one is a better stock? Clearly, the one has greater earnings yield, right? So it's a very direct metric of earnings power. But there's more to this, because there's more to this. So we're going to talk about that after we come back. It's already 11:40, so we'll take a 10-minute. We'll take a 10-minute. 38. So I don't know what my my Fitbit is saying 11:40. So we'll come back in 10 minutes. Okay, we'll come back in 10 minutes. Take a 10-minute break. All right, we're back. We're back. Okay, in the meantime, somebody dropped a chat. The salient shares profit. Yeah, earnings. You mean shares profit? That's earnings per share. Okay. Now, so you now understand. Basically, you know. We all understand that part of the EAT or per share in case of, right, we know EAT divided by number of shares. So per share concept of EAT, right? Earnings per share. Part of earnings per share is paid out as dividend. Okay? Part of earnings per share is paid out as dividend. So that part, like, you know, how much of the earnings per share is paid out as dividend? That percentage is called the dividend payout ratio. Okay, we call it D, lowercase. Lowercase is always, you know, some rate. Lowercase is by convention is some rate. So that's dividend payout ratio. I don't have to write it. I'll just, you know, dividend payout ratio, dividend payout ratio. So think about it. You might wonder, oh, that will be wonderful. It will be wonderful if they pay out all the earnings per share. But look, I told you, companies don't pay out earnings per share, entire earnings per share. They don't distribute it. They just, if you want, you sell the stocks, you recoup it. But it belongs, I mean, theoretically, it belongs to the shareholders. That's why, you know, because it belongs to you. When you sell it, you recoup it because the earnings per share is reflected in the new share price, right? Price at time one. But think about it. How much they pay out? The company that is fast growing, right? A company that's fast growing, so-called growth firms, they don't pay out anything. No, they don't pay out dividend. In other words, growth firms, the dividend payout ratio is 0, right? They don't pay out because they need to gather, they need to grab every penny. They need to grab every penny, you know, and reinvest it into their growth, right? That's how they can grow. So for them, the dividend payout ratio will be 0%. But you know, generally the companies, you know, pay out some dividend as a token. You know, it's nothing but a token, symbolic meaning only. That they are sharing profit with the shareholders, right? So, theoretically, therefore, the dividend will go up or down with the earnings, right? If the earnings go up, EAT goes up, right? The dividend will go, even if they use 10% dividend payout ratio, 10% or 20%, right? So the payout ratio is relatively constant. So if the profit goes up, then the dividend will go up. Profit goes down, dividend will go down. Even at the same, because the payout ratio is the same. But if the payout ratio goes up from 10% to 20%, dividend may be bigger even when earnings go down. But then obviously when earnings go down, there's no reason for any company to increase their dividend payout ratio, right? Think about it. Anyone with anyone intelligent, with even minimum intelligence would understand. Would No manager with even minimum intelligence would make such a decision, right? Why would you increase payout ratio when the profit went down? They will only raise that when profit goes up, right? Profit goes down, they will lower. But the point is, this dividend payout ratio, so that means 1 minus dividend payout ratio is what? 1 minus dividend payout ratio is called, plowback ratio, called B, right? Literally, you plow back So what is being plowed back is used for reinvested. It is reinvested into the growth of the company, right? So 1 minus D is B, right? B means plowback ratio. Then the plowback earnings per share times 1 minus D is what? Retained earnings. That's retained earnings. Of course, this is per share, retained earnings per share, retained earnings per share, retained earnings per share. And that automatically means that the EAT times B, or 1 minus D, is retained earnings. Okay, retained earnings. Now, here's an interesting thing. Of course, you think, obviously, it's easy to understand that the bigger, the higher the B, the higher the plowback ratio, so let me please. Okay, so the high, as the plowback ratio goes up, the growth rate will go up. Isn't that right? Because plowback, the companies plow back their retained earnings into their growth. So the more is plowed back, the more of the net profit is plowed back into the company, the growth rate goes up. So think about it. The company that does, and that makes perfect sense, because the fast-growing companies, the growth firms, do not pay out dividends, and they shovel that back in, they plow back that all back into the growth. They reinvest it all back into the company, so the growth goes up. So then it also means if they pay out that means if this is 0, if B is 0, that means dividend payout ratio is 100%. If they pay out everything, as dividend, that means dividend yield will be not, in other words, instead of it will be like this, right? It's not dividend yield. It will be completely earnings yield. And this, if dividend yield is earnings yield, right? If dividend yield is the same thing as earnings yield, that means what? This company is zero growth company. The company doesn't grow. Make sense? If they are paying out everything, all of the earnings as dividend, in other words, if this is dividend is completely, 100% of the earnings is paid out as dividend, then this company's growth rate, growth will be zero, right? This is a company that has so this is the problem. Although I've been telling you, earnings yield is a good metric of earnings power. But then if you have high earnings power, you should use that for growth. If you just pay it out to the shareholders, then it will have zero growth potential, right? It will have zero growth potential, right? Does that make sense? So here's the mechanism behind it. This is what this is what is this explains that. This is the plowback ratio. Plowback ratio is basically 1 minus dividend payout ratio. Growth rate is basically return on equity times plowback ratio. Return on equity times. So return on equity, we all know what return on equity is. Return on equity is net profit over equity. This is how you okay. Return on equity is net profit over equity. Of course, if I put time subscript, this is the net profit at time 0, right? Equity at net profit at time 1, equity at time 0, right? We can also rewrite it as EAT at time 1 over equity at time 0. Now, this is one of the profitability ratios, right? One of the profitability ratios, right? And equity is, productivity. Profitability is basically productivity of the assets, and equity, productivity of the equity can be directly measured by EAT divided by equity, right? Because this is the output. It's a very clear output to input ratio, very simple and straightforward output to input ratio, right? And productivity is basically measured by output over input. It's just like gas mileage. I mean, you put a gallon of gas in the car, put a gallon of gas, and how many miles does it run? if it runs, 40 miles per gallon, obviously that car is more efficient and more productive, right, than the car that gets only 10 miles per gallon. And that's the reason why it is called fuel economy. Gas mileage, that's the reason why gas mileage is called fuel economy or fuel efficiency, right? The higher the productivity, the more efficient it is. So efficiency is, the maximum. We don't call low productivity efficient. We call very high productivity efficient. Isn't that right? Efficiency is basically a maximum or high productivity. Right, everyone? Since I can't see.
Yeah. Hi,
Hi.
Professor. I'm sorry to
Yeah.
interrupt. I have to run now. And
Oh,
I
yeah,
have
yeah,
to
yeah.
go.
You
But
don't have to.
I was here the whole session. I'm so sorry.
No.
Have a great
Listen.
afternoon.
Who is this? Sebastian?
Sebastian. Yeah.
Okay. Yeah, you can. You're not disturbing anybody by leaving, so you can leave quietly, right?
Okay.
As long as you
I'm sorry,
have.
Professor.
No problem. As
Okay.
long as you
Bye.
have
Sorry.
already. Take care now. As long as you have put your name there, right? Hopefully, Sebastian, you're
Yes,
there.
yes, I did.
Okay,
Yes, I did.
good. Okay.
Bye, Professor.
All righty. Take care now. So you can leave quietly, right? Because later I can all check, from Collaborate. I can tell how many minutes you've been here. I mean, it's all the statistic of that. When you disconnected and when you rejoined, everything can be seen later. But so I trust you guys. I mean, this is gentleman's agreement, so I expect everyone to be present in the Collaborate for 85% of the time at least. But as long as you have been present 85% of the time, then if you have to go, you can excuse yourself, just quietly, right? Because you're not disturbing anybody by leaving, right? I mean, in an in-person class, if you leave and you are sitting at the back of the classroom and you walk all the way in front of everyone, and the door is usually in the front of the classroom, you will be distracting some people, or but this is online. You can just walk. You can just leave quietly, right? So where was I? So return on equity is the very basic metric of measuring the productivity of the equity, and stock is the equity, right? So to find how much the stock will grow, to find the growth rate, right? The colors. The very basic growth rate is then return on equity times plowback ratio. Okay? So think about it. It's a common, once again, borrowing from the concepts of the set theory, right? It's an intersection of these two rates, right? Growth rate is the intersection. They have to work together. Return on equity and plowback ratio must work together. So some people might think, growth rate will be something, much bigger than return on equity and plowback. No, actually, it will be a smaller number. Why? return on equity will, obviously these numbers are less than 1, right? Between 1 and 0. I mean, even if the return on equity is 20%, right? That's 0.2. Plowback ratio, let's say 80%. In other words, that means dividend payout ratio is 20%. You pay out 20% of the earnings per share as dividend. Then 80% of that will be plowed back. So 20% return on equity is already a very high return on equity. If any equity can, return 20% profit, right? That's already very good. But you do these numbers, right? It doesn't become, because they are the numbers between 0 and 1. If you multiply a number between 0 and 1 by another number between 0 and 1, it becomes a smaller number. I mean, it will be 0.16, right? Smaller than both, right? Because, two zeros, right? So that brings us to we already understand because of this growth potential, right? We can express, we know price of the stock. Actually, I better use, V0 because we're talking about the intrinsic value. Intrinsic value is dividend at time 1, or price plus growth rate. We all understand we've done this already many times, right? This is growth rate, right? Dividend return, I'm sorry. The expected return, right, is right growth rate plus dividend over P0, right? And then what is being actually, it's here. So here, it's not P0, it's more. It's K or R, it doesn't matter. Okay. Right? Now, think about it. If we solve this equation for, so here, this was a little bit mixed, but what I'm trying to say is, so I have to rewrite the whole thing. So what this is saying is, price of the stock is basically, we know it's dividend discounted by the required return, plus present value of growth opportunity. In other words, and if earnings per share, look, when it's not completely earnings per share, when it is dividend, then we have present value of growth opportunity. But if it is entirely earnings per share, the present value of growth opportunity is 0, right? In other words, to put it another way, a company that pays out all the earnings per share has 0 growth opportunity, right? Basically, because the price of the stock is the dividend yield. I'm sorry, not dividend yield in this case. Dividend future cash flow discounted by the required return plus the present value of the growth opportunity, right? But if the growth opportunity, present value of the growth opportunity will be positive if they are not paying out all the earnings per share. In other words, just paying out only the dividend. If the dividend is, if they pay out everything, all the earnings per share as dividend, then the present value of growth opportunity will be 0, because no growth value is the when you are paying all the earnings per share, right? In other words, dividend payout ratio is 100%, plowback ratio is 0, then growth rate is 0, and it will be, you won't have any in other words, in this formula, right? Think about it. If you're paying out all the earnings, right? Dividend, that means growth rate is 0, because plowback is 0, right? And because 100% of the earnings is paid out as dividend, right? The numerator will be earnings per share, and denominator will just be K, right? Because growth rate is 0, right? So 0 present value of growth opportunity, right? For more about the present value of growth opportunity, we're gonna talk about it in a couple of sections later, because after this, we're gonna look into the variable growth model, and then fixed free cash flow model, and then we're gonna go more into detail, right? We're gonna go into more detail about present value of growth opportunity, right? Together with price earnings ratio. Price earnings ratio is basically the reciprocal of earnings yield. All right. So we're out of time. Any questions so far? Any questions? Any questions so far? No? All righty. If you have no further questions, have a great afternoon and have a great weekend. And I will
Professor,
see
can
you.
I ask you a question? Sorry.
Yeah, you can. Hold on, and I'm gonna say goodbye to everyone, and I will stay on. So
Thank you.
all righty. So Yeah.
All right, goodbye, Professor.
All right. Take care, everyone.
Have a great weekend, Professor.
All right, you too. Class is dismissed. So I'll stop sharing and stop recording.